everybody. My name is Marisol Menendez, and I'm Head of Open Innovation at NFI, Nordic Future Innovation. And here we are always looking for new ways to connect, to inspire, and we are surrounded by amazing people like you are seeing today, and always looking to learn, to inspire, and to connect. And to do that opening for the day, let me welcome Irene Trambach, CEO of NFI. Irene, the floor is all yours.
Thank you, Marisol. Thank you. Dear all, welcome and thanks for connecting today. As always in NFI, we are focusing on living out our mission, bringing the Nordics together to boost global sustainable innovation. Today's topic is central bank, digital currency, and cryptocurrency. What does it mean for business and banking? We know this is a relevant topic. Since 2008, Satoshi Nakamoto launched the idea of Bitcoin and blockchain. Nowadays, Bitcoin represents plus $650 billion market. Also, with the idea of a new central bank digital currency that would be a game changer in international finance. It's therefore gratifying that we have got some of the best in this field here today to discuss this very relevant topic. It's a pleasure to see engagement from top players like European Central Bank, Mastercard, specialist David Birch, and our very own Chris Skinner, creating a unique combination of minds to bring light to this very interesting topic. I also want to thank our dear friend Lasse Meholm, who helped us curate this session, and will also share his insight about the state of the art in the Nordics. We hope you will have a great afternoon together with us, and I invite you to give us your feedback and keep connected with NFI future activities. And now I will introduce you to today's moderator, NFI Chairman of the Board, Mr. Chris Skinner.
Everyone in Nordics and other parts of the world. I'm here in sunny Spain, taking a short break after holiday, but decided I'd join the NFI group for the next hour and a half to talk about central bank digital currencies, which obviously I've thought about a lot by the pool on the beach and playing with my kids in the last week or so. The main thing I would say is to begin with some definitions of terminologies, because we get everything very integrated and confused. Cryptocurrencies, digital currencies, Bitcoin, Ethereum. And I've spent quite a long time in the last decade specifically looking at the rise of cryptocurrencies that are decentralized, thinking that it's not going to work. And having had that thinking, I think I'm wrong. And I think a lot of people are saying they were wrong, because in the last year, particularly since the lockdown, cryptocurrencies have risen dramatically in value and support amongst the corporations rather than the individuals. And certainly for the first decade, it was very much the libertarians and the anti-institutional people who wanted to buy into decentralized cryptocurrencies. But now we see corporations, treasury, and other parts of the system buying into the idea that actually cryptocurrency might be the right thing. I did a blog for an April Fool saying that Venezuela had replaced their national currency with Bitcoin. And I even had many Venezuelans contact me saying that they thought this was true. It was a joke, but it might as well be true. And more recently, El Salvador has actually announced that they will accept Bitcoin as legal tender instead of the US dollar as their currency. So things are moving dramatically in a direction that we don't know the outcome. But I think it's got to the stage now that we cannot continue to deny that cryptocurrencies are having an impact on how we look at the exchange of value across borders across the world. Many years ago, I argued there should be a global currency for the internet, because the internet is global. It doesn't recognize countries and country borders. And maybe one of these cryptocurrencies, I don't know which one, will be that global currency. Then we have Ethereum, which actually is much more supported by institutions and corporations because it's permissioned and more centralized. And this is where the debate gets interesting between centralized and permissioned currency systems versus decentralized and permissionless currency systems. Again, I don't know the outcome of that argument. What I do know is that banks would much prefer to have a centralized permissioned network of currency exchange than something that's not controlled and is completely democratized. Whether they win that argument, they've been having that argument for a decade and they haven't yet seen the outcome. What we have seen is the governments wake up and shake up by the lack of control of permissionless decentralized networking currency exchange and saying we need to issue our own currencies. And central bank digital currencies are nothing to do with cryptocurrencies. They're fiat currencies being distributed electronically through the network, maybe through the bank network, or maybe directly to the individual or the institution. And that's another part of the debate. Will central bank digital currencies circumvent the banking system and take the might and the power away from banks and disintermediate them? Or will banks still be the central intermediaries between the central banks and the institutions and the individuals? These are the questions we're going to talk about today. We don't have the answers because, as I say, for a decade, nearly all of the banks and companies I've dealt with have said that Bitcoin is a scam. In fact, they call it shitcoin. And now it's taking over and getting trillions of dollars of money moving into those markets. I was actually talking with a bank the other day that's quite well known called JP Chase, and mentioned the fact that Jamie Dimon has spent the last certainly 7 years saying how awful Bitcoin is. It's a Ponzi scheme. You'll lose all your money. It's got no value. There's no asset behind it. It's just a complete scam. And yet now JP Morgan is trading Bitcoin for their institutional clients and recommending it as part of their portfolio and estimating that Bitcoin is going to rise in value to $150,000 a coin within the next 12 months. So they must have changed their position. And they said to me, well, no, Jamie Dimon still says Bitcoin is rubbish, but if our customers want that asset, why should we stop them having that asset? So these are a lot of the things we're debating. And I think at the end of the day, my question would be, do we really need digital currencies, and what do we need them for? And which currencies should we focus upon? 3 simple questions. We'll get to those when we get to the panel discussion, but as Irene mentioned, we have a number of commentaries before we get to the panel open debate from Lasse, Jesse, and Jonas. So maybe to begin with, Lasse, Meholm, you are working now looking at a lot of these areas as the Ernst & Young lead digital assets and distributed ledger technology tax and law partner. Tell us what you think.
Yeah, sure, absolutely. I'm glad, and thank you for inviting me. I'm very much looking forward to this. I'm gonna share my screen, share screen, the whole screen, and share. I guess that's it. I put this a little bit outside. Okay, so my focus now is the status of the Nordic central banks, and I have been working with DNB, the largest bank in Norway, for 3 years, being head of blockchain and distributed ledger technology. I also worked 3 years with Nordea, the largest bank in the Nordics. So I have a little bit from the banking side view of this thing. Today I'm a part of a team in Oslo, in Norway, by EA Tax and Law. We are focused on the technology side. We also focus on taxation of costs, and since most of us, not me, but the other ones are lawyers. And we also focus on regulation when it comes to cryptocurrencies, CBDC, DeFi, and stablecoin, and so on. So to begin with, when I mention Nordic, it's Iceland, Norway, Sweden, Denmark, and Finland. The Nordic is a little bit different from the rest of Europe. I need to move this a little bit out, sorry. Because the Nordic is extremely digitally matured. All of us do have, almost all of us have mobile phone and smartphone and so on. We do have high trust in banking and government, maybe the highest one in Europe. We are almost zero unbanked in the Nordic. We have a digital identity in most of these countries. In Norway, we have something called Bank ID, and with Bank ID, my digital bank ID, I can open a new bank account in a new bank if I like, whenever I would like to do it. I can file my tax calculation to the authority. I can buy and sell property, signing with by digital identity, my bank ID. So we have a digital identity in most of these countries, and we have an efficient payment infrastructure already. So Holger, if there's anywhere, any place in Europe you should use as a sandbox for CBDC, it should be the Nordic. We are so prepared for it. And if you look at a little more statistic here, in 2018, ask, did you pay by cash the last time you paid something? In Norway, the 11% answered yes, Sweden 13, Denmark 23, Finland 54, and Greece 88. Iceland is very close to Denmark here. Looking at the total number of transactions in cash, you see the yellow line here is Sweden. It's going from 40% to almost zero. And the question is, when will we become cashless, whether we have CBDC or not? Someone says 23, 24 or something. In April, the Norwegian Central Bank said less than 3% pay by cash in Norway in April 2021. The blue line is overall Europe, and the top one is Germany. So we are very close to being cashless as it is today. If you go around in Sweden, Norway, Denmark, you often say we are cashless, or we only take card like this. In Norway, we have a hair cutting chain. They also open up in Sweden and Denmark. They cut hair, cut time, cut cost, and cut use of cash. Even the Salvation Army in Norway accept mobile payment, not card, but no mobile payment. People living on the street accept mobile payment. If you go to a restaurant, bar, and something in Norway, you need to download an app. In the app, you order your food, your drink, and you also do the payment. No cash at all. So cashless society in the Nordic is very close to being a reality. So if I take one by one of these countries, I start with Iceland. The last formal report they had was in September 2018. The currency in Iceland is krona, and the CBDC is named Rafkrona. So the report said that there have not been this decision taken when it comes to CBDC, and it has to be a political decision as well. Rafkrona will have to be addition to cash. Rafkrona will be available to general public, what we call retail CBDC, and it will be 24/7 real time. The last thing in this list is quite important because Iceland has a quite rough time during the last financial crisis. So what they say, the Rafkrona, the CBDC, can contribute to financial stability by reducing financial institution systemic importance. And that is very important when it comes to CBDC, and especially for Iceland, having this history. So cash in circulation increased during the financial crisis, but it's still higher than the rest of the Nordic. When it comes to Denmark, they had their last report in 2017. They had Per Callesen of the central bank in Denmark had a speech April a few months ago. But what they say is that our system is so good. We have instant payment. Do we really need a CBDC? They follow the European project, the Digital Euro, quite closely. They have contact with Norway, Sweden, and Denmark as well. So the Nordic are talking together. CBDC will have limited effect on the day-to-day life in Denmark, said the central bank. So they do not have a plan for a pilot for now. The main question is, what benefit will CBDC have for private and business customers? Finland is a little bit different because Finland do have euro. It's a part of euro system. The last report is from August 2020, but and they do not have a plan for a pilot for now. because they are part of the euro system and they follow the digital euro quite closely. But Finland is very interesting because they was the first country in the world to go live with a CBDC. It happened in 1990, and the name was Avant Smart Card. It was a smart card system. So the central bank issued new e-money distributed via banks, typical two-layer architecture, and out to private persons and to businesses. So it's a typical two-layer architecture. But the Avant system lasts for 3-4 years or something, and then they closed it down. Now, as I said, they focus on digital euro. When it comes to Norway, I live in Norway, so I'm Norwegian. I live just outside Oslo. They had the last report April 2021. Last speech was from 11th of May this year by Ida Wolden Bakke. She's the vice president of the Norwegian Central Bank, and she said, "The direction is clear. Finance will be distributed as surely as fossil fuel will be. The question is not if, but when." And we Norwegians know something about fossil fuel income. The project started in 2017, first report in 2018, second report 2019, and then the third report now in April. In the central bank, there are 4 people that use quite a lot of time when it comes to CBDC, plus a number of people helping them, and they discuss and make a report. They also said in the last report that they had a large number of meetings with consultants, fintech company to prepare for this pilot. They also said maybe we should have a sandbox when it comes to fintech and regtech during the pilot stage here. They also said that maybe 3% of GDP should be within central bank digital currency, which means 90 billion Norwegian kroner. And this is almost exactly twice as much as cash in circulation in Norway today. So they plan to start a pilot second half of 2021 with more than one technology, not only one, but more than one technology. Run it for 2 years with a number of technologies, then find one technology to focus on, another 2 years with the final test of this one technology, and decide if, because they haven't decided if, and then decide if or when a CBDC should be launched. In this Norwegian report, they had the 18 bullet requirements. The first one is CBDC must be a claim on central bank. I take all of them because it's quite common for most of the central bank projects. CBDC must be a claim on central bank. Customer-oriented focus is important. There has to be a mechanism to prevent that public move money out of bank deposit into CBDC. Central bank has absolutely control over the technology and protocols. Law and regulation must be changed, and they all mention in the report a number of laws that has to be changed. Norway must comply with the EEA because Norway is not a part of the European Union. Norway is a part of the European Economic Area, so we have to comply with the rules. Payment must be final. There must be compliance with good IT architecture. The infrastructure should be parallel and independent, meaning completely backup of this system we have today. Know your customer, AML, CTF are to be done by other than the central bank. Privacy is important, so is GDPR. The impact of money policy is important. It is important that central bank macroeconomic receives relevant information for statistics, even online or real-time statistics. The technology must be DLT compliant, even though the core might not be DLT. The solution must be attractive, and the last one here is important. Many of these requirements are partly contradictory. A balance is important. For example, know your customer, AML, CTF contradict with GDPR and privacy. So the balance is really important. They also have a discussion in this report, what happened if people or moving customer deposit from the private bank into the central bank like this. then private bank might have a problem. But in that case, the report says it might happen that we can loan this cash back to the private bank, depending on whether the private bank has collateral with high enough security and quality for this. So there's a solution if this happens. Then the last country is Sweden. The last formal report is from April 2021. The last press release was a few weeks ago. And the press release said that we have onboarded Handelsbanken as a bank and Tietoevry as a fintech company into this pilot. The project started in 2017. And the reason they said was that there was a decline in use of cash. So people didn't have risk-free, credit risk-free money anymore. And also the question is, what role should a central bank have in the future? Stage 1 started February 2020, including Accenture as a consultant and Corda from DLT from R3. Then stage 2 started actually just before Christmas last year. They decided to continue during 2021. Stage 2 is split up in steps, and step 1 was finished by April this year. E-krona, as they call it, has a token design. User need a wallet, either in mobile phone, smartwatch, or smart card. There's a typical 2-layer architecture. And then this is quite different from other central banks. The token have value 1, 10, 100, or 200 Swedish krona. And if launched, it will be within 4 to 5 years from now, but it's not decided on. So the pilots started in February 2020 using virtual bank and virtual customer or virtual banks. This year, 2021, they will test with real banks and real customer or real banks, and also including fintech companies. So Handelsbanken and Tietoevry is onboarded in the project already. Looking at this, at the architecture, then the central bank issue CBDC. Then they have a notary node, and this is typical for Corda. They have a notary node, and today it's run by the central bank, but it might be different in the future. Then each bank and fintech company onboarded run their own node. Then the private and business customer, they have wallet either in phone, watch, or a card, and they do payment P2P, person to person, business to person, and so on. If you go into one transaction, this is again is from the report of the Swedish central bank, and this is a little bit different from other central banks as far as I've seen. Maria want to pay Johan 60. So Maria transfer a token of value 100. Then the notary node verified that this token is signed by the central bank, and then put it to use. It cannot be used one more time. Then the bank gets token back for 60 and 40. So 40 is putting back in Maria's wallet, and 60 is transferred to Johan's wallet. So this is a little bit different from other central bank as far as I've seen. So the plan for 2021 is offline solution with key and token stored locally by the user or centrally. Different combination of local and central storage of keys, token, and transaction. Include various methods of addresses. Capacity and scalability with the DLT technology will be tested more. POS and payment terminal must be tested with e-krona as well. Infrastructure must be assessed, which include structure, security, communication, and division of responsibility, meaning more or less governance. So that's my kind of update from the Nordic countries. Thank you.
Thank you, Lasse. I have one question for you before I move to Jess, which is looking at the Nordic region. From what you described, Sweden always seem more advanced than the other countries in their thinking of implementing a CBDC. how far ahead do you think they are to China or other leading countries that are considering implementation?
Well, I followed China quite close over the last few years. They launched the CBDC as a pilot in April last year, and now they rolled out to 28 cities and so on. And I mean, they call it a pilot. It's millions of people and more than 10,000 shops accepting this CBDC. We wouldn't call it a pilot, but they do. We are 5 years behind them.
How many?
5 years.
Yeah, 5. Okay.
I think so.
Madame Lagarde said it would be in 4 years. So Norway's a little bit behind.
Yeah, okay, maybe 4 years, but well, it's a different kind of thing because in China they have top-down leadership, so they just decide. In here we have a democratic kind of leadership, bottom up. So I mean, it's so much you have to do within the European. We have 19 countries using euro with CFA in each country, government in each country, central bank in each country. So it takes some time. But we are maybe, David, 4 years, but something between 4 or 5 years.
I'm going to come back to these questions at the end of the 3 presentations that come next. And David, I'm going to get you to kick off the panel discussion. So I'll leave this question with you, David, to think about for when the panel starts, which is, why do we need CBDCs? And we've got lots of alternatives. Jess, I'll come to you. I've known Jess for some years. In fact, you contributed to my book when you were at the World Economic Forum, and now you're with Mastercard, heading up their digital policy. And Mastercard recently started to embrace the idea of crypto. So what's happening with Mastercard?
I think, thanks so much, Chris, and really delighted to get to talk to folks here today. And I think I would say that Mastercard has been certainly exploring the blockchain and the crypto space for some time now. And what I'd like to do today is to do a few things. Firstly, I'd like to talk about sort of a framing for the world that we use when we think about the different types of innovations in crypto assets that we're seeing in the world. Secondly, I'd like to dive a little bit into the world of CBDCs and to a degree start to explore that question that Chris asked about why do we need a CBDC. And then thirdly, I want to talk a little bit about what Mastercard's doing in this space. What are the principles that are guiding our engagement with these new and innovative forms of payment? And what are the actual things that we're looking to try and build out? So diving right into this, I think it can be very confusing entering into this world of new payments. We've got a lot of different stuff going on. And I think it's troubling because there is no formalized taxonomy. Even if you look at different regulators, different central banks coming at this, they slice the world up in different ways, use different words to talk about things. And so I don't in any way want to try and present to you a definitive taxonomy of crypto assets here, but I want to talk a little bit about the way that we're thinking about it in the hopes that maybe for some of the folks on this call, it'll be useful for them. So we think about the categories of digital assets that are evolving today. One of them is the one that Lasse just sort of took us through, which is central bank digital currencies. This is the notion of, and specifically I want to focus here on retail payments, though there are some interesting developments in the wholesale space as well. But this is the idea of a central bank creating a new digital instantiation of central bank money, comparable to reserve assets that wholesale financial institutions can hold today, or the banknotes that all of us, might from time to time carry around in our wallets. It might leverage DLT, it might leverage a centralized system. There are a lot of different architectures being explored here, but they're definitely a new and quite distinct form of digital asset with the potential to have transformative effects on the financial system as a whole. The second sort of broad category falls within what you might call crypto assets. These are privately issued assets of value. And in that world, we at Mastercard really think about this in 2 categories. The first category is what are called stablecoins. These are cryptographic assets that are designed to offer stability to their holder by tracking a reference asset. Frequently, that's the US dollar, but it might include a variety of other currencies, potentially a basket of currencies, or even other crypto assets or physical goods like gold. But most frequently, and indeed sort of the ones that find themselves in greatest use, are crypto assets that are backed partially or preferably entirely by fiat assets kept in an account somewhere. I think the evolution of these assets has been quite interesting because their initial development wasn't really as a payment instrument, or at least not a broad spectrum payment instrument. But instead, if you were speculating in the crypto asset space, buying and selling Ether, Bitcoin, and the myriad of other altcoins that exist out there, you needed a mechanism for pricing those assets and for being able to trade into and out of them quickly and at relatively low cost. And needing to dip into and out of the traditional banking system added some time, some complexity, and some cost that people wanted to get away from. And so these stable coins got developed as a means of effectively facilitating capital market settlement in the crypto capital market space. But now we're seeing a great deal of focus on the idea that the use cases for stablecoins might expand significantly, might come to encompass a variety of retail, business to business, and cross-border payments. And so, as I'll talk about in a little bit, we're seeing on one hand, central banks, the Bank of England earlier this week, issuing a paper effectively saying that they're looking to regulate stablecoins of systemic scale in a way comparable to, though not the same as, deposit institutions. And companies like my own exploring how we could play an active role in facilitating the exchange of crypto assets, and specifically these asset-backed stablecoins, between a variety of actors, both in B2B and P2P and P2M use cases. And then the final category to think about, and which I think about as kind of separate and distinct from these two assets that have core and obvious retail payment uses, is the myriad of innovation that's happening within the crypto asset space. And so here you see a variety of investment tokens, Bitcoin being the most notable here. You see utility tokens, looking to set up distributed services, whether that be distributed financial services, distributed cloud services, messaging services. You see the explosion over the last 6 months of non-fungible tokens, effectively representations of ownership of art capsulated on the blockchain, and just really a massive amount of innovation in this space. But for the most part, it remains relatively young. And so when I think about this coming from a formal and regulated financial system, it's an area that we watch closely, that we think about in our labs as we do a range of experiments and explorations, but which in many cases doesn't yet have the formalized regulatory perimeter to allow us to engage directly with it. So having set the scene there over the past 3 or 4 minutes, I wanted to dive briefly into central bank digital currencies and to try and maybe steal David's thunder or give him something to react against when the panel comes up. Because I think one of the biggest mistakes that people make when they think about central bank digital currencies is they think about the initiatives being undertaken by central banks as being monolithic. We've really seen central bank digital currencies as a notion explode over the last 2 years, going from very few entities doing research in this space to something like 85% of central banks, at least doing research, many of those doing detailed technical exploration. And so it would be tempting to think that there's a single thing that has driven those central bank digital currencies, or that there was a single policy objective that central banks were pursuing. But instead, I think we need to break down those motivations. And for me, I think about them in 3 high-level buckets. The first are focused on creating a new digital store of value and responding to think about the evolution of the role of the central bank amid rapid technological change. And I think this is perhaps best exemplified by the Riksbank, wherein they have really clearly said that they believe that the central bank has an obligation to provide individuals with access to direct liabilities from the central bank, that they don't want individuals to necessarily need to be intermediated by the private sector and only be able to access so-called commercial bank money, that is sort of liabilities extended by commercial banks. This is, interestingly, an area even within the Riksbank on which there is disagreement about whether or not this is strictly necessary. But leadership seems quite committed to the idea that there really needs to be this asset in people's hands, and that as we move away from cash being a dominant and highly useful asset that provides that central bank liability, that the central bank needs to innovate to keep up. I think there's a second category of players that fall into this space, which is perhaps best exemplified by Canada. Canada has looked at the CBDC space, and specifically the retail CBDC space, and come to a very similar conclusion of Denmark. They said, look, we have a sophisticated payment landscape. We don't think that a central bank digital currency is necessary on a day-to-day basis. We don't think that it creates value. But we do have concerns that over time, the central bank might lose its monetary dominance, that is, its sort of role at the center of the financial system, as new crypto asset players come onto the scene. So we're going to build a CBDC, and we're going to keep it in the garage, effectively have an option on deploying it if we feel that it's either necessary, would create some significant new value, or could be an effective tool in pushing back encroachment from third parties, looking to undermine the monetary dominance of the Bank of Canada. And I think what's really critical to understand about this particular bucket of use cases is that this is a job that only the central bank can do. The central bank has a unique role in society as the lender of last resort, as the issuer of the currency. And so only they can really provide this unique central bank money that's distinct from the money that we interact with on a day-to-day basis. The second category of use cases that we're seeing in this space is new payments functionality. People saying, central bank digital currencies would be great because they could offer programmability and smart contracts. They could help to extend financial inclusion. They could make government disbursement, for example, COVID relief payments, more efficient. And I think this is absolutely true. Whenever you build new infrastructure, there's an opportunity to build it out as a more modern, inclusive, and effective form of infrastructure. But here, I think it's also important to recognize that central banks have competition. They're not the only one capable of providing these sort of efficiencies or these sorts of capabilities. And I think as central bankers look at this, you see them considering whether it's best to deploy this, A, via the central bank, and two, whether it's best to deploy it via central bank money or commercial bank money, because these same sorts of functionalities could also be deployed via existing or emerging central bank owned or government operated utilities, such as a real-time payment system. And so there's a need to think about what the right path to deliver these capabilities is. And then finally, you see domestic political aims, people exploring opportunities to bolster the systemic resilience against operational disruption or sanctions. You see countries looking to relaunch their currencies after having been dollarized. I think Cambodia is a great example of this. And you see folks looking to pursue a variety of domestic political aims. And central banks can be an effective component of that, though likely as part of a broader capsule of regulatory and competitive market structure efforts. The last thing that I'll say here is that I think while the motivations driving us to explore a CBDC differ, the challenges are common. You see a risk of large-scale substitution away from commercial bank deposits, something that most central banks want to avoid, wanting to figure out ways to keep the size of the CBDC relatively small and not to, directly provide this. I've yet to meet a central banker who wants to set up a customer call center, but also not to disrupt the unique role that banks play around credit intermediation within modern economies. And then thirdly, I think there's this idea of unintended spillover effects, that if you had a digital euro, the ECB has expressed concerns that it could disrupt the economies of smaller neighboring countries, effectively driving a digital euroization, or in the case of a digital dollar, digital dollarization, effectively making that sort of transition easier, not necessarily to the benefit of adjacent countries. And so just in the last minute or two here, I just want to talk a little bit about how Mastercard is thinking about this. It's a really exciting time, and we're really eager to play a role in supporting countries on their chosen path to payment modernization, and in playing an active role in enabling innovation within the crypto asset space. But we want to do that within the framing of three key principles. Firstly, that we want to be compliant with regulations, both local and global, wherever we operate. We think that's absolutely core to maintaining the trust of our government stakeholders as well as our broader community of players. Two, we want to offer strong consumer protection. Those may not be the same for each and every type of payment rail, but we think that it's absolutely critical that individuals know that they can have faith in their payment and that merchants can have that same sort of trust. And then finally, stability. Some crypto assets today remain extraordinarily volatile. And so they become difficult to use as an effective means of payment for all members of the payment ecosystem. And so that's why we're coming at this with, I think, three major prongs that I think are worth highlighting here. First, we have a crypto card program, which effectively aims to provide easy access to liquidity for holders of crypto assets who, following the run-up of valuations, may want to make purchases at their favorite retailer using a card that transits fiat, but is linked to a digital asset such as Bitcoin. Secondly, exploring the actual enablement of stablecoins on our network. That is the ability to use the Mastercard network and points of acceptance for an individual to transfer a stablecoin from their wallet or custodian to the wallet or custodian of a merchant. And thirdly, we've developed a central bank digital currency testing platform, effectively a digital environment to support central banks and members of the payment ecosystem, coming together, testing a variety of approaches to the deployment of a CBDC, and considering how to best achieve the policy goals of the central bank and the broader payments community through the deployment of a CBDC or some other type of payment mechanism. So I'll stop here, but excited to dive into this topic in more detail in the panel and to answer any follow-up questions that Chris, you have, or anyone else.
Surprisingly, I have loads of questions. I'm just going to ask you one directly because where you started was a focus on CBDC and stablecoin within Mastercard. But in February, there was this announcement that said Mastercard is preparing right now for the future of crypto and payments, announcing that they will support a select number of cryptocurrencies directly on the network with the philosophy that it's your choice. Mastercard isn't here to recommend you use cryptocurrencies, but we're here to enable customers, merchants, and businesses to move digital value, traditional or crypto, however they want. It's your choice, it's your money. Which cryptocurrencies can I use on Mastercard?
Well, today, there are a variety of crypto cards that allow you to spend at merchants balances of a variety of crypto assets. I think Bitcoin and Ether being the most notable of those. In the future, we're looking to enable crypto assets that are within a given jurisdiction compliant with these principles that I talked about. They are allowed to be held and to be spent within the jurisdiction. We've figured out an effective way of ensuring the security of the network and preserving consumer protections, and they offer stability. And so, frankly, I think what this means, at least in the near term, is that we are exploring stablecoins, fully asset-backed and properly regulated, subject to audits, effective capital buffers, effective liquidity strategies, et cetera, et cetera. But over time, as this ecosystem evolves, we may play a more active role in a wider variety of crypto assets. But I think in the immediate term, that focus is really on fiat-backed, properly regulated, fully collateralized stablecoins.
So I can't use doggy coins.
I believe it's pronounced Dogecoin, and no, I think that would be an asset that clearly doesn't meet this stability principle for us, because the reality is that the merchants and indeed a variety of players within the ecosystem need to be able to rely on that level of stability in order to appropriately control the risks within these systems. And so I think, that is the type of currency that could be linked to a crypto card, in which the custodian provides a commitment to provide spot liquidity for the asset, transferring it into the preferred fiat currency of the merchant. But no, I think Dogecoin as a direct sort of consumer to merchant transaction vehicle right now is not what we would think of as an optimal payment currency.
Better go and tell Elon. Dave, question for you to think about when we start the panel on this one is, I was talking the other day about non-fungible tokens, and someone wanted me to give the view against them rather than for them. And my view against them is, 50 or 100 years from now, will we be in the position, just like we are with PowerPoints and Microsoft Word and other systems, where you can't read the files anymore and therefore they're redundant and worthless? How will we continue to maintain accessibility of NFTs and crypto 100, 200, 500 years from now? But before we get to that, I want to come to Jonas Gross, who's representing the Digital Euro Association, which sounds interesting. Do we have a digital euro, Jonas? Perhaps you can give us an update.
So thanks for having me. I'm talking about an aspect, privacy of a CBDC, and in particular, I will focus on the digital euro today. You also introduced me as being part of the Digital Euro Association, which is of course correct. However, I also want to express that this is of no kind, of course, related to the ECB's Digital Euro project. So this is just a think tank around digital money we have started 1 year ago, but just to be very clear about it. Besides that, I'm working for the Frankfurt School Blockchain Center, which is a think tank around digital money, and I'm also focusing on central bank digital currencies in my dissertation. So I'm looking from an economic angle on these CBDC topics. However, I'm also working on the technology prototyping side, and this is something I will also share with you today. And you might also have seen the CBDC tracker out there, maybe a tool to compare global CBDC projects. This is also something I was part of the team. Great, so not to lose any time, let's directly dive into the topic. So privacy of the digital euro. As you might have seen, the ECB has in October last year published a report on the digital euro about like some basic ideas about the digital euro. And afterwards, they also started a public consultation. So basically asking the general public to provide their views on the digital euro, which requirements there should be, etc. And what was basically one result of this public consultation was that, privacy seemed to be quite important. So 43% of all survey participants, which was a little bit more than 8,000, basically perceived privacy as the most important requirement for the digital euro, which I found quite intriguing because, I mean, the second most important aspect was security with 18%. And I mean, security for me is kind of a no-brainer, right? I mean, who wants a payment system that is not secure? So I was really surprised that privacy was that far and that high on the radar. But what you also see, and this is something I've shown you with this figure, is that privacy needs and desires are quite heterogeneous about jurisdictions. So I'm personally from Germany, and here Germans seem to be privacy loving, if you want, and for Italians, on average, it seems a little bit different. So also here, preferences are quite heterogeneous. But what I want to stress here is that when you talk about the euro area, there seems to be a need for the CBDC to at least have some kind of privacy. Also, some other central banks think about using privacy enhancing techniques for the CBDC, if we, for example, look to Canada. But maybe one step back, why does privacy, from my perspective, seem to be important, and why also people demand it? And I think there are a bunch of reasons. I'm just focusing on a few today. And the first one is that privacy is kind of secured by civil rights. So if we think about freedom of expression, freedom of association, this all implies being kind of private and not reveal like every information to every authority and also to kind of everybody. It, of course, also prevents surveillance abuses in theory, right? Because if these data are not shared with specific parties and people, this does, of course, also not mean these data are of some kind used against one. And also the interesting aspect we have seen over the last few years that there have been some kind of data exploitations and leaks when we, for example, think about some email providers, etc. If data are private beforehand or not even stored in a manner that the party that has leaked the data or that other person basically can integrate and analyze this data, this, of course, also is quite interesting and seems to be a good idea that data leaks do not have like a large scale impact on these topics. And the last aspect I want to point out is that privacy also, of course, prevents specific transactions or prevents authorities to prevent specific transactions by individuals. So this is what you also think about in some jurisdiction where transactions are censored. If they are private, there is no need to, and there's also no way to do so. And why is now privacy especially important for payments? I think this is about the aspect of confidentiality of transaction data. So here in Germany, we are really kind of not eager to share a lot about financial information, right? So when you are privately talking about financial details about the salary, etc., then Germans at least get quite cautious. And therefore, I think that this aspect of privacy, I mean, it's so important for many fields, but I think this is also why it's essential to have it in the payment sphere. And some of you might now say, well, I mean, we do have cash, right? Cash is private, only the sender and the recipient know what's going on. And I don't need a CBDC for that. And I would kind of agree. But if we think about, look at to the Nordics, of course, the situation seems different, as Lasse has shown us. And also if we think maybe 10, 15, 20, 30 years ahead, where some market forces might lead to a lower role of cash, a CBDC, from my perspective, should be there to address this gap, right? And what we've also seen, and this was a reaction by the ECB, and here I refer to a paper by Fabio Panetta, executive board member of the ECB, is that after the results of the consultation, he also said protecting users' personal data and ensuring a high level of confidentiality will be a priority on our work. So what I want to stress with this slide is there is like a need of privacy in the euro area, and also the ECB has kind of communicated that privacy will also be in the focus on their work on CBDC. But how do I want to contribute today is basically to kind of show how one could implement privacy for a CBDC, because it's so many studies also argue there should be privacy, and I really want to lay out one way how to do this. So this is part of a current research project where we basically have implemented a prototype that provides these private payments. I would just like to talk about the next few minutes. So our goal is to develop a CBDC system. It's really like a small prototype, right? So nothing more, but to ensure cash-like privacy, so that basically only the sender and the recipients knows transaction insights, as for example, transaction amount. So this also means that banks, central banks, regulatory authorities are not able to access this transaction detail as we have for cash, right? As we don't have these third parties that can access transaction data, of course, we cannot rely on these parties to ensure privacy, because they should not even see the data in the first place, right? And this is where we basically use cryptography, or to be very precise, privacy-enhancing technologies stemming from cryptography, in our case, so-called zero-knowledge proofs, to really ensure that data are private and that no other party besides the sender and the recipient can access these transaction details. And also, this is something which is interesting, because Lasse mentioned this before, that we do not want the ECB to kind of check compliance or something. We let this basically do the users. So what we also have in mind about this prototype and we developed is, it's of course not just providing a completely private payment infrastructure, because this is something we today have with Zcash in the privacy coins field, right? And what we basically want to say, we also want a private form of money that is also regulatory compliant, because this is something also Lasse laid out, that this kind of seems to be a trade-off. However, we would argue that you could also do this, could this basically reach this simultaneously, right? So have private payments and be regulatorily compliant. And we implement this, kind of compliance aspect in the sense that individuals have to prove before they instruct a payment that they comply. So what do we mean by that? We basically say that we have two different CBDC payment rails. The first one is that ensures private payments. So if you, for example, want to do a transaction below a specific limit, then you can do this in a fully private way. This is similar how cash today works, right? You can do cash payments without KYC up until specific thresholds, and afterwards you have to provide and know your customer measures and provide your identity in most cases. And this is something, an idea we would basically also one-to-one apply to CBDCs, so that for small scale transactions you can do completely privately, and for large scale transactions you are basically have to do KYC. And what we basically see here is that our users have to prove the compliance by their own. So what we basically say is that before a payment instruction is made, the user has to prove that he is below this limit, right? So he has to use a so-called zero knowledge proof to show that, for example, if there is a limit specified, that he does not exceed this limit. And if this is the case, and this is fine and validated, then he can transact completely privately. And this is just implemented by design, by default. So there is no way in our system to be not compliant or not private, because this is completely implemented in the protocol. And as I said, we do not even store sensitive data. We just store nicely looking hashes. So we use these zero knowledge proofs, as I said, so no sensitive data are actually stored. So just give me the last few minutes to talk a little bit more about how our system looks like. So on the left-hand side, we have this so-called privacy pool where transactions are conducted in a fully private way. And this limit, of course, where transactions are private is something the regulator has to set, right? This is also what Ulrich Binster from the ECB said in a recent event, that this is not something the ECB wants to do. This is something the regulator does, and the ECB then would rather comply to this. And for us, we do not specify a specific limit. So we also say that this is something the regulator should do. But maybe a few aspects about privacy is that in our system, the central bank only knows the CBDC money supply. So it doesn't know more. It only knows how much money the ECB has issued. Besides that, we have so-called payment service providers in our system. So this could be, for example, banks or other licensed companies in the end, and they know a little bit more. So they know basically they are important for the on and off ramp into this pool. So when I, for example, enter the pool with 200 euros, then the central bank knows this. And also when I leave the pool. So this is similar how cash works today. When I go to my ATM, the bank knows how much money I deposit or withdraw, but the bank does not know which transactions I do in the end indeed, and how my current cash balance is. And this is something we one-to-one mirror in our digital world with this prototype. And as I said, we do not store any private data. So this is all ensured by so-called zero knowledge proofs, as I said, where you really just prove that you comply, that you are below a specific threshold. And if you basically have proved this, then you can transact completely privately, at least if you have not exceeded a specific limit, which is implemented in our concept, which have to be set by the regulator in the end. Yeah, and this is something we have also presented to various central banks, and we are currently writing a paper about it. This will be released in July. So if you're interested in that, you're of course very welcome to follow us. And to conclude, before we come to the very, very interesting panel, is I think privacy is an essential requirement for the ECB, and also the general public in the euro area seems to agree when we follow the consultation. The ECB has also put a focus on privacy, which I highly welcome. And what we basically want to do is to showcase a prototype how one could do this completely private payments, but not that they are just private, but implement and having them in a way that they can also comply with regulation using an approach that you can basically transact privately up to a specific threshold, similar as we know this today for cash. Yeah, thank you very much for the attention. I'm also very happy to answer any questions. Probably we don't have time for a lot, but I'm also very happy to answer them in the chat. And thanks for your attention.
Thanks, Jonas. I do have one question, surprisingly. And Holger, you may have a comment on this afterwards as well, but there's 19 countries that are using the euro. And let's say we get to Payment Services Directive 4 or 5, which implements the Eurozone digital euro policy. Would all 19 countries convert to that policy overnight on that date of implementation, or do you think some would say no?
Oh, that's really a tough one, really, to say. I mean, from my perspective, I'm also not a legal expert here, but I would assume that they indeed would do. And for our system, we have also designed it in a way that we do not rely on a distributed database, where also different central banks validate transactions. Of course, one could do this via DLT, but doesn't have to. But we have basically just said that we have basically a centralized ledger which is managed by the ECB, in accordance also with some payment service providers for the on and off ramp. So from our concept, we kind of do not really have to care a lot about these national jurisdictions levels, at least when it comes for the CBDC validation, because here the ECB is like the only validator, if you want, for the CBDC system.
Cool. I'm going to introduce Holger, but before I do, Dave, when we go to the panel, the question I have for you is, will we ever get a digital equivalent of cash that is truly anonymous? Because I think that's a challenge. You have to have an identification around the payment. Will we ever get something that's completely anonymous? Because there's going to be issues with that around money laundering, terrorism, etc. Holger, Holger Newhouse, you are the head of Division Market Innovation and Integration at the ECB, which we've heard mention of Christine Lagarde, so I'm sure you're best buddies with your boss. Maybe you can tell us a little bit around the ECB's view of the digital world.
Okay, I mean, since you refer to Madame Lagarde, then I would say, I mean, if you hear any difference between what she has said or will say in the future and what I'm telling you, believe her, it's better for my career. So that was the disclaimer for this presentation. No, just a second. It's not reactive. The presentation, but I use time until it comes on screen. I hope that you can see that now.
We can see it.
I use the, okay, well, so I use the time to answer your previous question. I mean, a situation, I mean, we have the ECB, Central Bank of the Euro system. So what, I mean, something which I cannot foresee is, I can imagine a lot, but I cannot foresee that actually there will be some countries actually issuing, I mean, where there would be a digital euro and some Euro area countries opting out. So that's something I cannot even perceive, I have to say. If we think of a rollout, so everything else then a test phase or so, or prototyping. So maybe I go through quickly through the presentation. Have a look at the watch. Yes. So have a look at the presentation. So basically, I also do actually, as I think it was Jesse doing that before, I have one slide on the forms of money and liability, but it means I can run through it more quickly. Our work on the digital euro in the next steps. So on the, I mean, it's similar to what was actually shown before. So this is the different type of monies that we see, or different type of liabilities. So at the very core, of course, I'm a central banker, so I might be biased, but are the liabilities of a central bank. I mean, that's for payment purposes, that's the very core that you actually want to use the currency itself. So the essentially risk-free asset in the given economy. What you see in that slide here is that, I mean, when there's so much talk about central bank digital currency, is it so new? I mean, in many aspects, it's not, because is there retail central bank money? Yes, it is. What it does not do, I mean, what is missing for us, I mean, it's based on the proven technology, which it's called paper, which even works in when there's settlement, when there's no electricity. It can move around freely. There's a lot of the anonymity or privacy features that you have in there. Of course, also that is not perfect, because when you go to a shop, somebody sees you. I mean, there's also some limits to that, but in principle, it's even anonymous. So what is missing there is the word digital, of course, because the only case where you can, if you think of a digital economy where you can actually pay ordering something on the internet, is where you kind of the type of where you order pizza for home and pay in cash, but otherwise it's very difficult. I mean, do that with a streaming service, it will not work. So the only central bank currency at this moment is cash, physical form, and that's indeed is one of the cases, one of the scenarios that we find important to be prepared for, also a digital economy, and such that also their central bank money could be used. Then actually below is central bank deposits, so that they already exist in the digital form. So to some extent, wholesale CBDC does exist. So of course, those arguing for more of that and wholesale CBDC, I mean, they will say that it's more sale than whole because there's a limited access. I mean, it's very limited typically to monetary, I mean, depending on the framework of a central bank, but generally to monetary financial institutions. So what we are focusing with the digital euro is to complement cash and deposits really on the retail side, opening up to the central bank digital currency for more wholesale purposes, changing hours, making it more easily available to more. That's something that's a different discussion. Then in the middle of that is the liability of a private entity. So, I mean, with commercial bank money, that should be exchanged for central bank money at a 1-to-1 ratio. So should also be a sound means of payment. That's already, commercial bank money is already in the digital form. There's e-money, and some stable coins would classify or could be classified here to the extent that they entail a claim or a liability on an identifiable entity. The third category, and that's the least obvious for using that in payments, I mean, that's crypto assets, in particular those that do not have an issuer, so where you do not have a liability on somebody. And I think there Andrew Bailey did a statement of what he thinks that somebody who is investing in it should be prepared for. Even if you do not believe that you will lose all, but as a means of payment for something which really changes its value quickly, I mean, that's not something you would really use for payments purposes, but the logic would be more for an investment. And of course, then afterwards you pay with what you have. On the second part, so key messages, I might be repetitive for some, but I think it still is useful to summarize from our report on the digital euro is, again, that it would be, as was said before, a central bank liability made available in digital form for use in retail payments. And really the key is it's a direct liability of the central bank. No matter who else is involved in the process, it's a liability on the central bank. It would complement, not substitute cash and also wholesale central bank deposits. We see that there are synergies with the industry and private initiatives when issuing, if and when issuing a central bank digital currency. And is it necessary? The decision of the Governing Council so far has been that a digital euro is not necessary so far. So the whole thing is about being prepared on our side. Possible advantages of a digital euro. I mean, we have identified several scenarios. There are several in the report. I highlight here the support of the digitalization of the European economy, addressing a declining use of cash as a means of payment, and also tackling sovereignty concerns related to international private digital means of payment or foreign central bank digital currencies in the euro area. So from our view, the point of view, the euro system needs to be prepared should the need to introduce a digital euro arise in the future, and to address both the risk of issuance and non-issuance. But I referred to before on what is the relationship to private initiatives. So we see that there would be a coexistence of several means of payment so that consumers have the choice. We also do think that the private sector will remain more innovative. As I said, our means of payment for the retail side is based on paper. Central banks do not have ambition to take up the front end or take away deposits from banks' balance sheet. The digital euro would be offered preferably through supervised service providers. How would it look like? How could it be done? So it could be account-based, or it could be bearer-based, where you can transact directly between two citizens. Otherwise, you have something which is account-based, so you have a system. Whether that is actually a variation of what we have as our instant payment systems, for example, which I put here in the chart with tips, whether it's DLT, those things are actually to be investigated still of what would be the right way to keep track. So on the functional scope, the digital euro would look like any other modern payment solution for both point of sale and online payments, be made available, and that relates to the question we just had, throughout the entire euro area. It would be supportive to financial inclusion, be mindful of privacy, topic we had before, by definition be a risk-free central bank money, free of charge for basic use by payers, allow, if possible, offline, allow to control for undesired effects of financial stability and monetary policy, for example, in the case of substitution of assets, so that we don't crowd out massively, as I said before, for example, bank deposits. Necessary elements in a viable product would be that the end user actually sees that it's valuable for them. So there would have to be quite some design decisions, which some of them I touched upon, some of them, at least implicitly now, they are more in our report. Some legal issues, not least on the legal tender question. We would have to think of what is the backend infrastructure, then the front end, as we said, we would like to involve intermediaries. And then how is it distributed? I mean, what's the distribution there? And also how is it interacting with commercial bank money and the digital euro? So there is further assessments are to be done as conceptual work. So we continue the analysis of different design options. We had the public consultation that was also referred to before. We have done also practical preliminary experimentation to test implementation of functional design options. We do work with the European Commission on a joint review of a broad range of policy, legal, technical questions, and we are in dialogue with other central banks around the world. In the public consultation, indeed, as was also mentioned already before, there was a strong preference for privacy with 43%. Followed by security, pan-European reach, no additional costs, offline. So those figures have to be taken with a pinch of salt. One does not know what the assumptions are. I mean, if of course people think that if the Euro system offers it, it's safe as well. I mean, they may not score it so high, the need for it. Another pinch of salt is that of course this is not a representative stratified sample of the Euro area. But we received here 8,000 replies, 94% were citizens, 6% professionals. Most contribution, nearly half of them came from Germany, 15% from Italy. And also, if our sample was representatives, we would only have a female population of 11%. So there's a strong gender bias also there. Still, I mean, we have to take and are taking those, those preferences mentioned here, of course, seriously, and see how can we address those points that have been raised. I will jump a bit over parts of the other points. I would also at this moment not go too much into experiments that we have done, but we look both at basing our infrastructure on existing settlement services. We looked at actually also decentralized technologies and also a combination thereof. We also experimented with electronic identities and linking that with decentralized technologies. And we also looked at hardware bearer instrument enabling offline transactions and safeguarding privacy as well. What is important is, so there will be a decision on the digital euro over the summer. What is very important that I would like to emphasize, it's not a decision whether it will be issued or not. It is a decision on whether we will launch a project, more precisely the investigation phase. So it's not for the implementation. It is to answer open questions from the report. It is to develop a minimum viable product, and it does not commit the euro system to issue a digital euro in the future. So it's more for us being prepared so we could take the plans out of the shelf and to issue a digital euro if the euro system decides to do so in the future. Thanks.
Thank you, Holger. And in fact, your last point related to the question I wanted to ask you, which is, and you may say, I don't want to answer it, is a digital euro inevitable and going to happen?
Yeah, I mean, I can answer it in a lot of words, but I mean, that is really for the governing council to decide. So I'm afraid that that would require somebody with a different pay grade here now. No, that's for our decision makers, and even those would only tell you after that decision has been taken. So I mean, you did refer to President Lagarde. She had offered her personal opinion on this, I mean, which is public knowledge, that she believed, I mean, in those where she was quoted as saying that she would believe it would take a few years until this is being paid. But she had emphasized that that was her opinion. And of course, the governing council is more than the president. Yeah, but you can see, of course, I mean, we would not, I mean, of course, we would not do such an effort to go through this, run the experimentation, if we would not take this very seriously and that this is a serious option to consider. So there's some likelihood, of course, behind it.
So I've got 4 key questions, and Dave's aware of 3 of them. The 4th I'll keep till the end as a secret. But let's go through a panel discussion around those 4 key questions, and with each one I want Dave to give his commentary first, and then if any of you want to make some observation, then join in after Dave's opening comments. And we began, and I think this relates to the question I just asked Holger, is this inevitable? Why do we need central bank digital currencies, or these developments at all?
Well, it's funny you should ask me that, Chris, because there are 6 key reasons why we want. Oh, wait a minute! I've lost my PowerPoint now.
There's 5 key reasons.
I'm not very good at this.
Oh, my memory. I've got 3 key reasons.
Right, here we go. Right, where are we? Share screen. Right. So there are 6 key reasons why digital currency is necessary and in fact inevitable. And Jesse has already alluded to some of these, albeit in a sort of ramshackle fashion. So here's a more organized version of it for everybody. So here's why it's inevitable. There are 6 key drivers. They're in 3 groups of 2. So on the left-hand side, you have the 2 which are to do with politics, which are to do with sovereignty and monetary policy. But also, as Jesse pointed out, people often overlook the external influence of digital currency. If there was, for example, if there was a digital dollar that everybody in the world could happily store in their wallets using presumably Mastercard's excellent technology, then something like 150 out of the 180 currencies in the world would immediately disappear, because no sane person in most countries would hold the local currency instead of holding dollars. So it's not just about internal sovereignty, it's also about external influence. In the center, you've got the 2 key points about the infrastructure. So one is we have to have strategies towards cashlessness. If we just let cashlessness happen, which is what's happened in Sweden, you'll get a backlash because you get groups that are marginalized and excluded. So cashlessness has to be an actual strategy. And in parallel with that, we want the introduction of digital currency to make for a more resilient infrastructure. One of the key reasons, so people say, well, why don't we just use M-Pay? Or why don't we just use faster payments? Well, first of all, not everybody has bank accounts, but also it doesn't add to the resilience. If we build digital currency on top of the existing system, then we just multiply the problems. And remember, this is not a hypothetical example, because we've had Target 2 go down, Bank of England RTGS has been down a couple of times, Visa Europe went down. In fact, when I was putting some slides together a few days ago, one of the big US gateways went down and all McDonald's was offline and so on. So we want to increase the resilience of the infrastructure. And as many central banks around the world have said, this means offline use. This means people must be able to transact with one another when there's no power and no mobile network. And that has implications, of course, because that rules out using blockchains and Bitcoin and all that sort of thing. Then in the right-hand column, you've got, if you like, the kind of other benefits. When I first started looking at this topic, nobody really cared about sustainability, but it's become rather fashionable recently, particularly among the young people. So in the UK, we've got the, whatever it's called, the Sustainable Cash Alliance. I forgot the name of it. The big banks and cash transport people are trying to reduce the use of single-use plastics and cut the number of journeys. Driving van loads of cash around isn't very sustainable. But of course, replacing that with something that's even less sustainable, e.g. Bitcoin or something, would obviously be mad. So, because we don't want to use up all the energy in the entire universe running our CBDC. But in the bottom right-hand corner, Jesse touched on this in passing. I actually think the point he made about programmability is the key point. What is the key thing that this new kind of money will give us that the old kind of money doesn't? Why do we call this smart money while we call the money in bank accounts dumb money? And it goes down to this point about programmability, which is the root of what people are starting to call DeFi and a different kind of financial system with a reduced cost of intermediation and different. So to answer your first question, Chris, why is it inevitable? There are the 6 reasons why it's inevitable, and I'm happy to defend those against all comers.
So let's just see if the all comers, Jonas, Lasse, Holger, want to make any comment.
No, I mean, by and large, I mean, that clustering looks fine for me. I mean, whether or not I would nuance some of the wordings, but I think that was a good summary of points.
Thank you, Holger. I appreciate it coming from you.
Would you agree, Jess, that yours was a ramshackle presentation?
Yes. I don't have David's intellectual brilliance, unfortunately, using 6 buckets instead of 3. I would agree with everything that Dave said. The only thing that I would say in addition that I think is important to be thoughtful about is, one, that while I think programmability is very interesting and potentially has significant value, central bank digital currencies are not the only way of delivering programmability, as we've seen in the DeFi space. And secondly, I think that it's important, particularly as we start to think about the sustainability aspect, to think about the differential value that's delivered by decentralization versus programmability. Programmability can be delivered within a centralized environment with a sort of single trusted hub, and I think that's what we're trending towards in the case of most central bank digital currencies. It can also be deployed in decentralized environments, such as we see in DeFi, and likely that's not bimodal, but instead is a bit of a distribution. And so I think that we will likely see over the coming years explorations of federated systems exploring this type of programmability. As within Mastercard, we are thinking about how we might be able to deploy programmability within our own network and enable these types of transactions. So I think we are likely going to see rich innovation across a spectrum of different assets and different levels of centralization around that programmability use case.
I mean, maybe on that, if even though I was already asked, but on that one, on the programmability, I mean, it's one of the points where I would say that there can be different value to the points that David had mentioned, and also how exactly it's done. It would be done in the future, and also that actually maybe account money at this moment is not so dumb, because I think that's the most used programmability feature, and that is, I mean, you use your bank account to pay your rent always on the last day of the month, or on the first day of the month, or whatever is it in your country. I mean, it's of course, it's a very easy programming, because it just depends on the date, and what actually is being looked for are other features. But that also shows it can be done also via other systems, even for account-based solution, and it does not always have to involve central bank digital currency.
But don't you?
So that's actually.
No, I agree with that, Holger. But I think where I mean, I probably agree with Jesse ultimately, but it's more fun to disagree first to get there. Is I think it's unlikely that the tokenized forms will be used for the retail central bank digital currency. So in other words, we will tokenize the retail bank central currency in order to use it in DeFi contracts. But the central bank digital currency itself, won't be tokenized. I'm pretty sure it's going to be account based, and that's because in order to do the offline transfers, we know how to do the cryptography around offline balance updating and subsequent synchronization. but allowing people to transact offline tokens completely beyond the control or visibility of the central bank and the AML, I just can't see that being allowed. I mean, I'm sure there are some technical ways that we could do that using secure elements and so on, but I can't see it being allowed. You know, you guys touched on it earlier on when you were skirting around the edge of anonymity. It isn't reasonable to compare the anonymity of digital currency with the anonymity of physical currency, because the implications of the usage are just so utterly different. If you allow anonymous digital currency of any value, I mean, even if you say we're going to have anonymous digital currency, but only up to 3,000 euros, that means anonymous digital currency. If it's anonymous, I could have, if I want to send 3 million euros to Jesse, I'll just have 1,000 of those accounts. If they're anonymous, you won't know who I am. The dangers of anonymity in digital currency are so great. So it's a way of saying, I think, I can't remember, think it was Jesse or somebody else touched on the wholesale point about using the wholesale tokens on the distributed ledgers to implement delivery versus payment and so on. Couldn't agree more. I mean, it's absolutely certain to happen. But for retail, I'm really not sure on the retail side.
You've raised the question that I was throwing out there, and by all means, Jesse and Helge, build this into your answer, because my third question was, can we ever achieve a cash equivalent that's digital? And what does that imply for identification and for money laundering and for criminal activity? You know, people in the chat area here said Monero is anonymous. It's not anonymous. If you actually wanted to, as a government agency, you could actually work out who was using those Monero transactions through various.
But even more than that, Chris, I think that what you see quite clearly from policymakers, and I'm going to paraphrase poorly Augustus Carstens here, is he said that the degree of privacy offered through cash is not an element of its design that we would necessarily choose to replicate today. That it is, you know, part of the technological limitations that we faced thousands of years ago as sort of a variety of notes and physical tokens came to serve the role of money. And that as we look to build new forms of money today, that privacy by design should absolutely sit at the center of those offerings, as it should, you know, across all of the payment offerings that we have. But that doesn't necessarily mean replicating the extraordinary degree of anonymity and the criminal risk that comes with physical cash.
I agree with Jesse 100%. When people say, you know, we need to use cash as some sort of design goal, I really don't understand it. Cash is a terrible product. It's too expensive, it's inconvenient, and the costs of it fall. Basically, the costs of cash are very diffuse, but they fall disproportionately on the poorest people. You know, it's people who lose their cash and get shaken down and have their cash stolen and don't have insurance and have to pay money to get out the ATM. It's poor people that, you know, the idea that cash is good because poor people use it is crazy. Poor people are trapped in a cash economy. Cash should not be a design goal for what we're doing in the world of digital currency. We should be setting the bar higher and building something that's better than that for the next phase of our human evolution.
Yeah, but in the criminal world, cash is the preferred utility because it's completely anonymous. It can be moved across borders. It can be stored in basements. There was a case the other day. They found millions of pounds in a basement somewhere in cash. So how do you persuade people to give up cash?
How do you
maybe to add on what David says, I'm a little bit more optimistic here actually, because I pay really everything with cash, and I think cash is great because cash for me, it provides private payments and it works in an offline way, right?
Are you a German?
It doesn't provide private payments, it provides anonymous payments.
I think he's a German.
I'm a German, exactly.
Look, it should not be part of the ECB's goals to support German tax evasion on such a large scale. I mean, that's a completely separate issue. But I think even I'm right in saying the Bundesbank's own figures showed that 9 in 10 of the euro banknotes that they produce are never used in transactions. Not just rarely used in transactions or occasionally used in transactions or sometimes used in transactions. They are never used in transactions. The banknotes that the Bundesbank produces go straight underneath the mattresses of drug dealers in Eastern Europe and tax evaders in Bavaria. It's not how this is not a benefit to society.
I don't agree here. I mean, I like that you like it when one disagrees. Therefore, I'm really open here to disagree.
It's not my figures, Jonas. It's the Bundesbank's figures. It's not my figures.
But I mean, it's also the Bundesbank and the ECB's figure showing that like more than 50% use of Europeans use cash as a means of payment, right? And this, of course, not just includes illicit activities.
Okay.
And almost every central bank has been very clear that they don't want to, that they will provide cash for so long as there is demand for it. I believe that's been a clear statement from the ECB, the Bank of England, and almost every central bank exploring a CBDC is an intention to continue to have cash as a product, but to provide a variety of alternatives.
Right. So the thing to do there, Jesse, is to carry on providing cash to people, but only coins. Get rid of the banknotes, produce a 10 euro coin. That's for honest people like Jonas, who is buying some cigarettes and doesn't want people to know about it. A 10 euro coin is absolutely fine. You know, for the occasional little bit of drug dealing or something, a few 10 euro coins is no problem. But money laundering with 10 euro coins becomes a real problem, right? So what we do is we allow people to carry on using cash, but not banknotes. Just get rid of the banknotes. You have a 1 euro coin, a 5 euro coin, a 10 euro coin. That's everything that Jonas needs.
Let's move on to my second question, David, because
just a second.
Yeah.
Sorry to interrupt. My PhD thesis is just around this topic, and it's totally technically possible. You made a private coin or a private crypto token, plus a lot of regulatory issue on top of it. We can have transaction, private transactions as much as we want, and unless we are outlawed, we can keep this privacy. But if we do anything out loud, out of law, we can have our privacy confiscated instantly. And there is a paper very interesting that Dave Sean has written with someone from the Switzerland Central Bank. And it's quite interesting because 40 years ago, Dave Sean wrote the first paper about private payments. And 40 years later, he wrote a paper around central bank digital currencies privacy issuing. So it's not two separate matters. We can have both together. If you wait 2 years, I'm not
arguing against privacy, Courtney, but I'm arguing against anonymity. I think the dangers of anonymity are just too great. It's very nice, when you're a computer science undergraduate, smash the state, down with the man. We should all have anonymous currency.
No.
It's a little different when you've got a mortgage and kids to look after.
I live in Brazil, and in '93, our president got in the TV in the Sunday night and say, "Hey, people, tomorrow everyone is going to have only $50 in your bank account because I'm going to confiscate everything." So
that's a problem. That's not a problem with money. That's a problem with Brazil. I mean,
it's a problem of our financial system. If we don't fight for privacy, then we are going to force everyone to go to private currencies like Monero, Zcash, and worse things ever. If we don't have privacy by designing central bank digital currency, we are going to push the population for the private coins.
I agree. I'm in favor of privacy by design, but that's not anonymity. And what David Chom is asking for, and which I'm extremely familiar with the system, I'm sorry to say I'm extremely familiar with the system from 40 years ago, never mind last month. But what he's asking for, I just don't agree. The risks are just too great.
Okay, I need to move to the next question because of time. Sorry, which is, if we tokenize
everything. Not being interesting, Courtney.
If we tokenize everything as we are, and NFT is a great example of tokenizing art and investments, what happens in 50 or 100 years when those tokens are no longer readable?
Well, I should say that remember, I'm sitting in the UK, right? I'm sitting in a country where the government, the Parliament of the UK, recently voted we're a very conservative nation, as you people know. So the government of the United Kingdom recently voted to carry on writing laws on vellum. Do you know what vellum is? Vellum is the skin of goats. So when there's a new law in England, you know, like we ban dangerous dogs or something, when there's a new law in England, the law has to be written on vellum, animal skin. And the Parliament just voted to continue writing laws on animal skin because they're not sure whether this whole paper thing is going to catch on, right? We're not sure about paper. We're on the fence. It might not, but we're conservative people. You know, we don't see this. So NFTs, no chance. You have to divide NFTs into two groups. There are NFTs that have utility. And I'll give you a very simple example, which is event ticketing. Event ticketing is a perfect example of an NFT where the market can clear itself in the absence of counterfeiting. So instead of Ticketmaster and all these other things, you take all the tickets from an event, you just sell them at auction, they're on a blockchain, nobody can counterfeit them. And when you show up, you just have to demonstrate ownership of the private key. And actually, I don't know if you'd remember, Jesse, but I worked on the Intel version of that with the hardware blockchain. So event ticketing is a really good example of an NFT that makes complete sense. So you have NFTs that have utility, you can use them for something. And then you have NFTs that have no utility. And that's what we call art. So things that are not useful, you know, those are art. And if you want to buy an NFT of art, then you are yourself part of the performance because it is meaningless junk. So if you pay, I mean, you can right now, if you want to, I have cartoons specially drawn for my Forbes columns by the very talented Helen Holmes. And the cartoons that are in my Forbes column, you can go right now, you can go and buy the NFT of those cartoons. I hope you do. Go and buy the NFT of those cartoons. And the NFT entitles you to absolutely nothing. Read the small print. When you buy the NFT, you're buying absolutely nothing. So basically, my plan is sell lots of NFTs, get a list of the names and addresses of the people that bought them, and then I have a variety of appropriate investment schemes to present to them. NFTs are stupid, but utility NFTs are going to be huge, going to be really big, because it's a way of clearing markets.
Really clear.
I'd say one thing here, and this may not be a direct answer to your question, but I think I would question to a degree, my personal point of view, the notion that we're in the process of everything being tokenized. To my view, tokens have unique characteristics that make them useful for certain use cases, and particularly useful while in motion, because they enable the type of programmability that David talked about. At the same time, and particularly when at rest, they present unique challenges from a security perspective. And so I would not be surprised to see more and more players exploring hybrid solutions that move assets into and out of and between a token and an account set of characteristics, depending on the way that asset is being used. So I think it is dangerous to presume that we are going to wake up one morning and discover that the entire world has been tokenized. Certainly there's a transitional period, and I'm not even sure that we're necessarily going to see a complete move on this front.
Well, I don't want to show the audience what's behind the curtain right here, but obviously there's a little bit of a difference between conference rhetoric and reality. And the point is what Jonas was pointing to with privacy pools and so on. I mean, this is this is going to be the way forward, isn't it? It's going to be it's going to be the use of those more advanced cryptographic techniques, so that you know that I have a valid token, you know that it comes from this group, but you don't know anything about the group. Whereas other people, might know something about the group and tracing. And I think I'm actually, although it's more fun to argue the other, but I'm actually very optimistic about the potential for these new cryptographic techniques to deliver the privacy by design that Courtney was talking about, but in this higher utility, programmable, smart money that we actually want. So I'm actually pretty positive about that, Jesse.
I'm aware of the time, and I need to make this the last question. It needs to be a short answer, and everybody, I think, will have a view, particularly Holger, on this one. But I'll start with you, Dave, again. How can a government stop a global decentralized currency like a Monero becoming a mainstream exchangeable value form that ignores CBDCs?
Well, you know, look, I think we already have examples of how to do that. So as I'm a naturally conservative person. I have quite a long memory for these sort of things. So, Chris, you'll remember in 1260 when the Emperor Kublai Khan introduced paper currencies throughout China. So, and obviously people were using the decentralized alternatives. They were using these copper coin, you know, the chains of copper coins on rope. And so Kublai Khan had a very straightforward policy. He said, if you don't use the paper money, then I will kill you. Now, that sounds a little harsh to modern ears, but it did have the merits of transfer. He was very clear. You knew where you stood with the Khan, is my point, right? So
actually,
all it takes is for the Justice Department to pass a law which says possession of Monero is a prima facie case of money laundering. And that's
stop for a second, because you tweeted something that resonated with me, which is, if you don't accept this form of payment, we will shoot you.
That was my Mondex idea.
Yeah, and people said,
we were getting desperate, Chris.
You can't kill people, but then you said, but you'd only have to kill one.
That was my, yes, I thought, you know, look, it's for the greater good, right? I mean, that's what they'll do in El Salvador, I assume. The first person who says they're not going to take Bitcoin.
Bang.
I don't know how it sits well with the sort of whiny Bitcoin liberals that you get in this sort of discussion. Oh, we're all against the state and whatever. We want decentralized and, you know, our own keys and whatever. And now there's a law. Now they've passed a law in El Salvador which says you have to take Bitcoin or you'll go to jail or something. Like, how do you reconcile those two things? That's insane. You know, look, what we need, to go back to Courtney's point, to Jonas' point, to what Jesse said earlier on, what we need is to focus our efforts on a privacy enhancing digital currency that meets these real goals. If you look at that normal distribution of people and what they think about things, I said to Lasse, personally, I'm against listening to the general public about things. You know, I'm not. Now you're looking at me in a bad way. I'm not anti-democratic, Lasse. It's just, it's not obvious to me that everyone should be voting. I mean, voting, yes, but everybody, I don't know. But if you look at that bell curve, there's a couple of % of people who are militantly in favor of anonymous digital currency, and they're wrong. And there's a couple of % of people at the other end who are militantly in favor of Chinese-style social credit scores and everything being, but most people in the middle aren't. Most people in the middle want privacy, and we as the industry, you know, should be trying to work out a way to deliver that to them, not sitting around taking on board whatever the technology guys do just because the technology guys think they can. It should be society that's setting the parameters on those privacy coins, and we should be putting in front of the regulators and the legislators this new spectrum of opportunity that we have now that we didn't have a few years ago. A few years ago, we didn't have zero knowledge proofs. We didn't have trusted execution environments in phones and so on. So look, I know I was making fun of one or two things, but my point is, Chris, I think we should be very optimistic if we take responsibility for driving forward that vision for something that's better than what we have now.
And I think in closing comments from my side, you know, what I've learned in this conversation, and it was in my back of my head, but it's very clearly in my head now, is we mustn't construct a digital currency world based on cash.
No.
It needs to be a new world built for digital exchange. Holger, Jesse, Jonas, Lasse, do you want to make any final comment?
Maybe to add what David said. So finally, David, we agree. So of course, I also share the attitude towards privacy. I also share that the market should kind of basically show the direction, right? So that you should not really turn everything down, which is innovative in a sense, right? I mean, privacy coins have issues when it comes to AML CFT enforcement, of course. But still, I mean, you can try, as is currently done for crypto, to regulate the on and off ramps. I mean, you can debate about this, but I'm really against like these hard stops. You say you forbid it, because also history has shown us, for example, in China, that this is really not a good way to basically forbid it and to really also lower market shares, etc. So I really like the way David pointed out, having like the society showing the way, and then also having projects as, for example, the Euro of the ECB, like providing and solving an issue, solving a problem that currently is there and is maybe taken by private sector initiatives. And this could be also something what the CBDC is for, as I also outlined in the presentation.
I guess I'll just say, Chris, that in response to the kind of question you asked about how can a central bank compete, I'll go back to the statement that you read from Mastercard earlier in the session, which is, I think that it's about customer choice. Subject to appropriate laws and regulations to control things like money laundering. I think that central banks and private sector players need to come together to provide offerings that are preferable. And I think it's clear that both the established private sector and central banks have unique characteristics and unique capabilities that leave them well positioned to win that battle for consumer choice. But it's something that we're going to have to work hard to earn.
Okay, I find it difficult to contradict the thrust of what has been said, basically, because it's even written in our digital euro report that where we, and even was in my presentation, one of the scenarios, and that was precisely whether it's another public CBDC, a foreign, or whether it is actually a private solution that would be too popular, in particular if it doesn't have very nice features. So it is about making attractive other solutions that can be private solutions and actually also paying in commercial bank money. So to make those attractive enough, it can be a CBDC, so retail CBDC. And also then actually working also separately or in parallel on that, also on other international remaining cross-border payment issues that there are, so that actually that facilitate making payments also cross-border in an efficient and fast and cheap way. Among the attractiveness features, I think will also be, in addition to easy usability, will also be the issue what was discussed before, I think also on privacy, because you mentioned one certain thing, but it can also be if it's a big tech issuing something which runs then on their network, they could have all the data when you pay with it, use it accordingly. So among the points should also be adequate level of privacy. And I deliberately did not say anonymity, because that's for me is in my opinion, I find it very difficult if the public sector would offer something in a digital way, very convenient to use, and then you in a way that you would not be able to exert controls on anti-money laundering, countering terrorist financing. Not even exposed, not even when you have a suspicion. So at some point in time, so I think full anonymity, that really is difficult with any digital means of payment, but an adequate level of privacy. And there, Jonas had mentioned something. We had also discussion papers out. As I said, we experimented. There are many ways to deal with privacy, and who knows what at what stage, and does have to know what can be revealed afterwards if there's a court order or whatever. So that really there can be a public trust, not only in the privacy, but also that actually it's not used for purposes you do not want money to be used for. Thank you.
Thank you. I'm sure we could talk a lot more. It's been a great conversation, and the only reason I have to shut it down now is I need to get back in the swimming pool. So we need to move along, but I think I'll summarize the conversation based on what David said just a minute ago, which is you've got those who want complete anonymity, you've got those who want complete traceability. The balance in between is what the individual wants, which is to own their data, their privacy, and share it when needed. The next meeting of the NFI group is going to be September the 16th. Iron, Marisol, did you want to say anything to close this Zoom meeting down?
Yeah, I would just like to thank you all. It's been so exciting, and it's been a fantastic atmosphere, and it's really, really great. And so thank you all. And I see that we have a lot of continents here participating today, and it's really engagement into this. And the debate was awesome. It was exactly how it's going to be, the atmosphere of NFI. So thank you so much. And September 16th, we will come back to you with the topic. We haven't decided yet, but hope to see you then. Thank you all.
Yeah. If any of you have any views on what topic you'd like covered next, feel free. I've got quite a few ideas, which I'll be discussing with Irene. Marisol?
Thank you very much, everyone. This has been so exciting and engaging. You know, we had like a parallel conference and discussion in the chat. This is amazing, guys. September 16th, we will do even more.